7 days ago, on December 23, 2025, silver did something it hasn't done in human history. It broke $70 per ounce, then $72. Then it kept climbing. Today, December 27th, silver is trading at 76, and 5 major American banks are now bleeding over $30 billion in losses. This isn't a market correction. This is a system failure happening in real time. The financial media will tell you this is just precious metals volatility. They're lying. What you're witnessing is the moment when the paper market, the system that has controlled silver prices for decades, finally collided with physical reality. And physical reality is winning. Here's what they don't want you to know. For the past 15 years, 5 U.S. banks have held massive short positions in silver. According to CFTC data, these institutions are short approximately 708 million ounces, nearly an entire year of global silver production. When silver was trading at $30 to $33 in October 2024, these banks were already underwater by $1.3 billion. But that was when silver was at $33. Today, it's at 76 hours. Let me do the math for you. Every single dollar that silver rises costs these banks approximately $78 million in collective losses. Silver has risen roughly $43 from those October levels. That's over $30 billion in realized losses and counting. But we're not talking about theoretical risk. We're talking about money that's gone, evaporated, destroyed by a market move that wasn't supposed to happen. But here's where it gets terrifying. These banks can't just walk away. They're trapped in what traders call a short squeeze. They sold silver they didn't own, promising to deliver it later at lower prices. But prices aren't going lower, they're going vertical. And now these banks have a choice. Buy silver at these stratospheric prices to close their positions or face delivery demands they cannot fulfill. Think about what that means. Some of the most powerful financial institutions in our country made a bet that silver would stay cheap. They sold promises to deliver metal they didn't have, banking on being able to buy it back later at lower prices. It's worked for years, decades even. But in December 2025, the music stopped. December 2025 will be remembered as the month the COMEX, the primary U.S. futures exchange for silver, experienced what analysts are calling a vault drain emergency. In the first 4 trading days of December, over 47.6 million ounces of silver were claimed for physical delivery. That's more than 60% of COMEX's total registered inventory in less than a week. Think about that. In 4 days, traders demanded physical delivery of more silver than has ever been drained this quickly in COMEX history. The registered inventory, silver that is actually available for delivery against futures contracts, has collapsed from 346 million ounces in 2020 to roughly 150 million ounces today. We're watching the paper market break in slow motion. And it's not just COMEX. According to data from the Shanghai Futures Exchange, Shanghai silver inventories dropped below 446 tons in December, the lowest level since 2016. London vaults are reporting similar stress. The entire global silver market is experiencing what can only be described as a physical supply crisis, while paper contracts continue to promise delivery of metal that doesn't exist. Here's the mechanism they never explained to you. For years, silver has traded in 2 parallel universes. There's the paper market, futures contracts, derivatives, ETFs, where banks and hedge funds trade promises of silver. Then there's the physical market, actual metal bars, coins, and industrial stockpiles. The paper market has always been orders of magnitude larger than the physical market. It's supposed to provide liquidity and price discovery, but what it really provides is control. As long as most traders are happy settling their contracts in cash rather than demanding actual metal, the paper market can create as many silver contracts as it wants. It's fractional reserve banking applied to commodities. The system works perfectly until the moment everyone realizes the vault is empty. That moment arrived in December 2025. Industrial buyers who actually need silver for solar panels, electric vehicles, and electronics started demanding physical delivery instead of accepting cash settlements. Investment funds that promised their clients exposure to real silver, not paper derivatives, started standing for delivery. And suddenly, the mathematical impossibility of the situation became impossible to hide. The numbers don't lie. According to the CFTC's Commitments of Traders report, there are approximately 150,000 open futures contracts for silver on COMEX. Each contract represents 5,000 ounces. That's 750 million ounces of paper claims. But COMEX only has 150 million ounces of registered inventory actually available for delivery. That's a ratio of 5 paper ounces for every 1 physical ounce. You know what happens when 5 people show up at a bank demanding the same dollar? The bank fails. That's what we're watching happen to the silver market right now. The bank is failing, the vault is being drained, and the people holding worthless paper promises are starting to panic. The Silver Institute, the industry's leading research organization, reported that 2024 marked the 4th consecutive year of global silver supply deficit. The world consumed 282 million ounces more silver than was mined and recycled. 4 years of deficits have drained above-ground stockpiles to critical levels. This is why COMEX vaults are empty. This is why Shanghai is scrambling. The metal is being permanently consumed faster than it can be replaced, and here's what makes this different from every other commodity squeeze in history. This demand isn't speculative. In 1980, the Hunt brothers tried to corner the silver market through pure financial speculation. Regulators changed the rules, forced liquidation, and the squeeze collapsed. But in 2025, the squeeze is being driven by genuine industrial demand that cannot be regulated away. The solar industry alone consumed approximately 200 million ounces of silver in 2024, according to the Silver Institute. Electric vehicles added another 90 million ounces. AI data centers, defense electronics, 5G infrastructure, all of it requires silver. You can't build a solar panel without silver paste for conductivity. You can't manufacture an electric vehicle without silver in the motor contacts and charging systems. You can't deploy next-generation military electronics without silver for thermal management and conductivity. This is structural demand, not speculation. And structural demand doesn't care about margin calls or exchange rule changes. It just keeps buying until the shelves are empty. So here we are, silver at $76 and climbing, banks hemorrhaging billions, COMEX vaults approaching empty. And the question isn't whether the system will break. The question is, what happens next when the paper market that has controlled silver prices for decades finally admits it has no metal to deliver? This has happened before. In 1979 to 1980, the Hunt brothers, Nelson and William Hunt, attempted to corner the silver market by accumulating over 200 million ounces. Silver spiked from $6 to the $50 per ounce in months. The COMEX panicked and changed the rules mid-game, implementing emergency position limits that forced the Hunts to liquidate. Silver crashed, and the Hunts were ruined. Their fortunes destroyed by regulatory intervention that came too late to prevent the chaos, but just in time to protect the banks. But here's the critical difference. In 1980, the squeeze was caused by speculators accumulating silver. In 2025, the squeeze is being caused by genuine industrial demand colliding with finite physical supply. You can't change the laws of physics. You can't regulate away the fact that solar panels require silver paste, or that electric vehicles need silver contacts, or that AI data centers consume silver for thermal management. The solar industry alone consumed approximately 200 million ounces of silver in 2024. Electric vehicles added another 90 million ounces. Defense electronics, medical devices, 5G infrastructure, water purification systems, all of it requires silver. And unlike 1980, this demand isn't speculative. It's structural, it's permanent, it's the foundation of our economy's transition to renewable energy and advanced technology. The Silver Institute reported that 2024 marked the 4th consecutive year of global silver supply deficit. 282 million ounces consumed beyond what was mined and recycled. 4 straight years. That's not a temporary imbalance, that's a structural crisis. 4 years of deficits have drained above-ground stockpiles to critical levels. This is why COMEX vaults are empty. This is why Shanghai is scrambling. The metal is being permanently consumed faster than it can be replaced. Think about what that means for our energy future. The Biden administration and now the Trump administration have both committed to aggressive solar deployment targets. According to the Solar Energy Industries Association, the U.S. aims to deploy enough solar capacity to power 100 million homes by 2030. Every single one of those solar panels requires silver. The average panel uses about 1/3 of an ounce. Do the math on 100 million homes worth of panels. And you're talking about hundreds of millions of ounces of silver that must come from somewhere. But it won't come from increased mining. 75 to 80% of silver comes as a byproduct of copper, zinc, and lead mining. Higher silver prices cannot dramatically increase silver supply unless base metal economics also justify ramping up those primary mines. Silver production is structurally inelastic. You can't just mine more silver the way you can drill more oil wells. On December 2, 2025, the CFTC released its monthly bank participation report. For the first time in recorded history, U.S. banks flipped from net short to net long in silver. Let that sink in. For decades, literally decades, U.S. banks have been net short silver always, every single month. It was the one constant in precious metals markets, as predictable as gravity. Until December 2025, according to analyst Craig Hempy at Sprat Money, who has tracked these reports meticulously since 2014, this has never happened before. The combined 22 banks surveyed still show a net short position of 42 hours, 311 contracts, but U.S. banks specifically are now net long. This suggests that American banks, likely including J.P. Morgan, which has faced $920 million in fines for silver market manipulation, have closed their short positions and reversed course. Why would they do this? Because they've seen the COMEX inventory data. They know what's coming. When the biggest players in the rigged game suddenly switch sides, you don't ask questions, you pay attention. These banks have access to data and analysis that retail investors will never see. They have trading desks monitoring vault movements in real time. They have compliance teams calculating exposure limits, and they made the decision to capitulate. J.P. Morgan's history in the silver market is particularly instructive. In 2020, the bank paid $920 million to settle charges of manipulating precious metals markets through spoofing and other illegal trading practices. According to the Department of Justice, J.P. Morgan traders placed thousands of fake orders to manipulate prices between 2008 and 2016. That's nearly a decade of systematic manipulation. But here's what's fascinating. While J.P. Morgan was paying fines for manipulating silver prices downward, the bank was simultaneously accumulating physical silver. Industry analysts estimate that J.P. Morgan accumulated somewhere between 600 million and 1 billion ounces of physical silver during the years they were suppressing prices through their trading desk. They were playing both sides. Suppress the price with paper trading. Accumulate physical metal at artificially low prices, then exit the short positions when the game is nearly over. If that's true and the circumstantial evidence is compelling, then J.P. Morgan just executed one of the most profitable trades in financial history. Buy physical silver at $15 to $25 per ounce while your trading desk keeps prices suppressed. Then flip long and watch the price go to $76 and beyond. That's a generational wealth transfer orchestrated through market manipulation that was technically illegal, but ultimately just cost them a $920 million fine. Pocket change compared to the profits on 1 billion ounces at these prices. On December 25, 2025, Christmas Day, Chinese silver markets went parabolic. Local prices in China hit record levels, creating persistent premiums over London and COMEX benchmarks. In some cases, Shanghai contracts briefly moved into backwardation, meaning immediate delivery was worth more than future delivery. This is the market screaming physical shortage in the clearest possible language. Backwardation shouldn't happen in commodity markets. Normal market structure is called seam contango. Future delivery prices are higher than spot prices to account for storage costs and interest. When a market goes into backwardation, it means physical scarcity is so acute that traders are willing to pay a premium to get metal right now rather than wait for future delivery. It's the equivalent of paying extra for next-day shipping because you desperately need the product tomorrow. China accounts for over 50% of global industrial silver demand, according to the Silver Institute. They control approximately 70% of silver processing and refining capacity, and they're not exporting. Instead, they're pulling silver from London and COMEX vaults into Shanghai for domestic industrial consumption. This creates a bifurcated market, a China price for physical metal they control and a world price for everyone else scrambling for scraps. The geopolitical implications are staggering. Silver isn't just a monetary metal anymore. It's a strategic industrial commodity. The U.S. military requires silver for missile guidance systems, radar components, and defense electronics. Solar panel manufacturers need it for conductivity. Electric vehicle makers can't build motors without it. And China is cornering the physical supply, while Western markets trade worthless paper contracts. Think about this scenario. You're a U.S. defense contractor with a contract to deliver missile systems. Those missiles require silver components. You've been buying silver futures contracts on COMEX, expecting to take delivery when you need the metal. But when you stand for delivery, COMEX offers you cash settlement instead because there's no physical metal available. Meanwhile, China has the physical silver but isn't selling to foreign buyers. What do? How do you fulfill your defense contract? This isn't hypothetical. This is the vulnerability being exposed right now. Our industrial supply chains, our defense manufacturing, our energy transition, all of it depends on access to physical silver. And we've outsourced control of that supply to markets that can't deliver in countries that may not want to sell to us. The World Gold Council, which also tracks silver markets, has noted that investment demand for physical silver has surged alongside industrial demand. The Bank for International Settlements, in their quarterly review of derivatives markets, has noted the growing concentration of precious metals, derivatives positions among a small number of banks. This concentration creates systemic risk. When 5 banks control the majority of short positions in a commodity, and that commodity goes into a supply crisis, those 5 banks' problems become everyone's problems. We learned this lesson in 2008 with mortgage derivatives. Concentrated risk in opaque derivatives markets can metastasize into systemic failures that threaten the entire financial system. Silver might be the canary in the coal mine. If 5 major banks are facing $30+ billion in losses on silver alone, what other derivative exposures are lurking in their portfolios? What happens to their creditworthiness, their counterparty relationships, their ability to meet margin calls in other markets? The Federal Reserve doesn't publish specific data on individual banks' commodity derivatives exposure, but the Office of the Comptroller of the Currency reports that U.S. commercial banks hold approximately $8 trillion in notional derivatives exposure across all categories. Precious metals are a tiny fraction of that, but losses cascade. A bank hemorrhaging billions on silver positions might be forced to liquidate other positions to raise capital, creating selling pressure in unrelated markets. This is how contagion spreads. This is how a crisis in one small corner of the derivatives market becomes a systemic event. We're not there yet, but we're watching the dominoes line up. Let's run the numbers that Wall Street doesn't want you to see. Let's do the math that explains why this situation is mathematically unsolvable at current prices. Current state as of December 27, 2025. Silver price $76 per ounce, fresh off an all-time high of $791 hit just yesterday on December 26th. COMEX registered inventory approximately 150 million ounces, down from 346 million in 2020. Total COMEX open interest roughly 150,000 contracts, which equals 750 million ounces of paper claims. The ratio 5 ounces of paper claims for every 1 ounce of deliverable silver sitting in the vault. Now let's look at the supply-demand fundamentals for 2025. Global mine production approximately 835 million ounces. Total global demand approximately 1.2 billion ounces. That's a deficit of 282 million ounces for the year. Industrial demand alone, solar panels, electric vehicles, electronics, consumed roughly 665 million ounces. Investment demand, jewelry, and other uses made up the rest. Here's the critical calculation that exposes the fraud. If just 10% of paper contract holders demand physical delivery, COMEX would need to deliver 75 million ounces. But they only have 150 million ounces registered. That's half the vault gone from just 10% of contracts standing for delivery. If 20% demand delivery, the system breaks. There's no inventory left. The game is over, and we're already seeing the velocity accelerate. In the first 4 trading days of December, 60% of registered inventory was drained. 60% in 4 days. At that rate, the vault hits zero in less than 2 weeks. Now, deliveries don't happen continuously. They cluster around delivery months. But the point stands. The velocity of physical demand is accelerating beyond anything COMEX has ever experienced based on historical precedents and current supply dynamics. Here are the price levels to watch. These aren't predictions. These are mathematical inevitabilities if the supply-demand imbalance continues. $82 to $85 per ounce, likely hitting in Q1 2026. This is the critical mass level. Multiple analysts, including Andrew Maguire, a well-known precious metals trader, have identified this range as the point where COMEX's price control mechanisms completely break down. At $82, the 5 banks' collective losses would exceed $35 billion, enough to trigger margin calls, forced liquidation, and potential credit downgrades that would reverberate through the entire banking system. This is also the level where silver would match its inflation-adjusted 1980 peak on a percentage basis. The 1980 high of 50 per ounce equals approximately $170 to $185 in today's dollars, depending on which inflation metric you use. But in 1980, that price was reached through pure speculation, and it collapsed when regulators changed the rules. In 2026, if silver hits $82 to $85, it will be driven by structural supply deficits and industrial demand that cannot be regulated away. Think about what $82 silver means for industrial users. A solar panel manufacturer that budgeted for $30 silver suddenly faces material costs that have nearly tripled. Do they raise prices and risk losing market share? Do they absorb the costs and destroy their margins? Do they halt production and wait for prices to fall? Except prices aren't falling because the supply deficit is structural. This is where the real economy collides with the financial crisis. Higher silver prices don't just hurt banks with short positions. They threaten the entire energy transition, the electric vehicle revolution, the 5G infrastructure build-out, all the technologies that our government has bet trillions of dollars on. $93 to $100 per ounce projected for mid-2026. Long forecast, an analytical firm that tracks commodity markets projects highs of $9,380 in early 2026. BNP Paribas, one of Europe's largest banks, has a year-end 2026 target of $100. These aren't fringe analysts or gold bug newsletters. These are mainstream financial institutions revising their models to account for the reality of supply deficits. This isn't speculation. This is based on the mathematical reality that if the 282 million ounce annual deficit continues, and if industrial demand grows another 10 to 15%, which is the Silver Institute's projection based on solar and EV deployment plans, there's simply no price that would bring enough supply to market fast enough. Remember, 75 to 80% of silver comes as a byproduct of copper, zinc, and lead mining. Higher silver prices cannot dramatically increase silver supply unless base metal economics also justify ramping up those primary mines. You can't just turn on a new silver mine the way you can increase oil production by drilling more wells. Silver production is structurally inelastic, locked to the production decisions of base metal miners who may not care about silver prices if copper and zinc prices don't support expansion. $150 to $170 per ounce, potentially reaching in 2027. This is the true inflation-adjusted equivalent of the 1980 Hunt Brothers peak. Some analysts, including contributors at Zero Hedge and other financial commentary sites, are calling for targets in this range if the short squeeze fully develops and COMEX is forced to settle contracts in cash rather than physical delivery. Here's the scenario that leads to 150 plus silver. COMEX announces it can no longer guarantee physical delivery. Contracts are settled in cash at the COMEX price, but physical silver, actual metal you can hold, trades at a massive premium to that paper price. Dealers who have metal demand $150, $107, maybe more. The market bifurcates into paper and physical silver, just like we're seeing with the China premium right now, but on a global scale. At that point, anyone who owns paper silver, ETFs, futures contracts, mining company shares, watches helplessly as the real metal they thought they owned disappears into a cash settlement while physical premiums soar. The wealth transfer from paper holders to physical holders would be one of the largest in financial history. Now, let's talk about the dates that matter, the moments when this crisis could accelerate or crystallize. January 20th, 2026, CFTC Chairman Rostenbaum departs. His successor will inherit a COMEX silver market on the brink of collapse. Watch for potential regulatory interventions, emergency position limits, forced cash settlements, trading halts, or rule changes that favor the exchanges and banks over contract holders. History shows us that when the financial system faces existential threats, regulators protect institutions, not investors. The Hunt brothers learned this in 1980 when COMEX changed margin requirements and position limits specifically to destroy their silver position. If you're holding COMEX silver futures in January 2026 and regulators decide to stabilize markets by forcing cash settlement, you'll learn the same lesson. The rules can change mid-aim when powerful institutions are threatened. Early February 2026, this is the January delivery period for COMEX futures. If December's 60% vault drain was a warning shot, January could be the kill shot. Open interest for January delivery is at record highs for what's normally a minor delivery month. If physical delivery demands continue at December's pace, COMEX registered inventory could hit zero before the delivery period even concludes. What happens when a futures exchange has zero inventory? Technically, they're supposed to declare force majeure, suspend trading, and settle contracts in cash. But the political and financial implications would be catastrophic. It would be an admission that the entire precious metals derivatives market is fraudulent, that the price discovery mechanism has been a lie, that decades of managed prices were pure manipulation. March to April 2026, the Federal Reserve is projected to implement additional rate cuts during this period based on current economic projections and inflation trends. Lower interest rates eliminate the opportunity cost of holding non-yielding assets like silver. When Treasury bonds pay 5% interest, there's a trade-off to holding silver that pays no yield. When Treasury bonds pay 2.5%, that trade-off narrows considerably. Rate cuts could accelerate investment demand on top of existing industrial demand. Pension funds, sovereign wealth funds, and institutional investors who have avoided precious metals due to opportunity cost might suddenly allocate capital to silver as a hedge against monetary instability. Even a small allocation shift, say 1% of global institutional assets moving into physical silver, would overwhelm available supply. This isn't a prediction, this is an observation of a system already in failure mode. The paper silver market has operated for decades on a simple premise that only a tiny fraction of contract holders would ever demand physical delivery. It's a fractional reserve system, just like banking. The bank doesn't keep all depositors' cash in the vault because statistically, only a small percentage of depositors withdraw cash on any given day. And just like a bank run, once confidence breaks, the whole structure collapses instantly. When depositors suspect the bank doesn't have their money, they all rush to withdraw at once and the bank fails, not because it's insolvent, but because it's illiquid. The assets exist, just not in immediately accessible form. December 2025 was the month confidence broke, when 60% of registered inventory disappears in 4 days. When Chinese premiums go parabolic, when banks that have been short for decades suddenly flip long, when backwardation appears in futures markets. These aren't coincidences. These are the tremors before the earthquake. These are the warning signs that anyone paying attention can see. Here's what's coming. Comics will eventually be forced to settle contracts in cash rather than physical delivery. It's the only mathematical outcome when paper claims outnumber physical metal by 400 to 1 in some derivative markets. When that happens, and it could happen during the January 2026 delivery period, the price of physical silver will decouple entirely from the paper price. You'll see two prices. A comics price that's meaningless because it doesn't represent actual tradable metal, and a physical premium that reflects actual scarcity. During the 2020 disruptions, physical coins traded at 60% premiums over spot. In December 2025, premiums are climbing again. Once comics breaks, those premiums could double or triple overnight as dealers and industrial buyers scramble for any available metal. For investors, this means the window to acquire physical silver at anywhere near current prices is closing. Not closed, closing. Every day that passes, more inventory gets drained from vaults. More industrial users lock up supply. More investment funds stand for delivery. The musical chairs game is entering its final round, and the music is about to stop. For the global financial system, the implications are darker. If 5 major banks are facing $30+ billion in losses on silver alone, what other derivative exposures are lurking in their portfolios? The 2008 financial crisis taught us that concentrated risk in opaque derivatives markets can metastasize into systemic failures that threaten everything. Lehman Brothers didn't fail because of their mortgage portfolio alone. They failed because losses in one area triggered margin calls and counterparty fears that cascaded into a liquidity crisis. Could silver be the trigger for the next systemic crisis? Probably not by itself, but it could be the catalyst that exposes broader weaknesses in the derivatives markets, in bank capital structures, in the interconnectedness of financial institutions that we're told is safely managed, but never truly is. And for the real economy, a silver supply crisis means industrial production disruptions. No silver equals no solar panels at scale. No silver equals constrained electric vehicle production. No silver equals 5G infrastructure delays. The energy transition that our government has bet trillions of taxpayer dollars on requires silver. If the price goes vertical or physical supply becomes unavailable at any price, the entire green energy agenda faces a hard stop. Imagine telling voters that we can't meet our climate goals because we ran out of silver. Imagine explaining to automakers that EV production has to be rationed because there's no silver for motor contacts. Imagine the geopolitical implications when China controls the physical silver supply that our military needs for defense electronics and our economy needs for industrial production. This is the collision between financial engineering and physical reality. But when paper claims outnumber physical assets by orders of magnitude, when banks hold concentrated short positions in commodities, they can't deliver. Silver hit $76 this week. The all-time high of $79.111 was hit just yesterday. The system didn't just crack, it broke. The comics vaults are being drained at unprecedented velocity. Banks that manipulated prices for decades are capitulating and flipping their positions. China is hoarding physical metal while Western markets trade worthless paper. And the math says this is just the beginning. The title said it's over. I meant it. The era of artificially suppressed silver prices maintained by paper market manipulation and fractional reserve derivatives trading ended in December 2025. What comes next will be determined by physics, not finance. And physics always wins. You can manipulate prices, you can change regulations, you can settle contracts in cash. But you cannot create silver out of nothing. You cannot produce more than geology and mining economics allow. You cannot escape the mathematical reality that when annual deficits persist for years, eventually the stockpiles run out. We're watching that moment arrive in real time. The question isn't whether the paper market will break, it's already breaking. The question is whether you understand what that means for your investments, for the economy, and for the financial system that we've all been told is stable and well managed. Because it's not. It never was. And December 2025 is the month the lie became impossible to maintain.